Imagine you invested $1,000 in NIO back in 2018. What would that be worth now in March 2024? The answer might surprise you. Your investment would have dwindled to $876, a decrease of 12% over the course of 6 years. But what if you had decided to pull your investment at the end of 2020 or early 2021? You would have seen an 8-fold increase in the value of your investment in just 2 years. These dramatic fluctuations in NIO's stock value are intriguing, aren't they? It's like a roller coaster ride that only the bravest investors dare to take. But why did this happen? What factors led to such a significant drop in the value of NIO stock after its initial surge? To understand why this is the case, we need to delve into NIO's financial situation. Let's start by looking at NIO's revenue. In 2023, NIO's revenue hit an impressive $7.8 billion. If we trace back to 2018, we see a compound annual growth rate, or CAGR, of 62%. This is a significant growth rate showcasing NIO's ability to scale its operations and capture market share in a competitive industry. The year-on-year growth in sales has been impressive as well. From 2018 to 2019, we saw a 56% increase. Then from 2019 to 2020, there was a whopping 131% increase. The trend continued into 2021 with a 128% increase. However, the growth rate slowed down in the following years, with 21% in 2022 and 13% in 2023. Now let's break down the revenue structure. 88% of the revenue comes from vehicle sales, and the remaining 12% comes from other sources. This shows that NIO's primary revenue driver is its vehicle sales, and it has yet to diversify its revenue streams significantly. But, as we all know, revenue is just one side of the story. It's essential to understand how much of this revenue is translating into profits. The gross profit margin for NIO in 2023 was 5%, which is consistent with the 5-year average. However, the net profit margin stands at a negative 38%. The gap here is due to substantial costs incurred in 2023, with research and development accounting for 23% of the revenue and selling, general and administrative expenses taking up 24%. From 2018 to 2023, these expenses have shown a downward trend. However, the average gross profit margin of 5% indicates that NIO might be underpricing its products to boost sales or facing high production costs due to low manufacturing volumes. Now, let's shift our gaze to NIO's net profit. In 2023, NIO reported a net loss of $3 billion. From 2018 to 2023, the net profit trend has been increasingly negative. The company's losses have been mounting, from a loss of $1.3 billion in 2018 to a loss of $3 billion in 2023. Despite the increase in revenue, NIO's net profit shows a different story. Stay tuned as we delve into NIO's assets and ratios in the next segment. We also need to evaluate NIO's assets and financial ratios. In 2023, NIO's total assets were valued at $16.5 billion, a significant increase from the previous year's $13.6 billion. The net assets for the same year were worth $4.2 billion, slightly higher than the $3.9 billion in 2022. But what does that mean? Well, these figures tell us about the company's ability to cover its liabilities with the assets it owns. Now let's delve a little deeper and examine the equity to total assets ratio. In 2023, this ratio was 25%, slightly lower than the 29% recorded in 2022. This ratio is a measure of financial leverage, indicating the proportion of total assets financed by shareholders' equity. The decline suggests a slight increase in financial risk for NIO. Next, we'll take a look at the company's liquidity ratios. The current ratio in 2023 stood at 1.22, compared to 1.28 in 2022. The quick ratio, on the other hand, saw an increase from 1.09 in 2022 to 1.14 in 2023. These ratios measure NIO's ability to pay its short-term obligations, with higher values indicating better liquidity. Finally, we turn our attention to NIO's inventory days and receivable days. In 2023, the inventory days were 47, a significant decrease from 71 in the previous year. This indicates an improvement in inventory management, with NIO turning its inventory into sales faster. On the other hand, the receivable days were 33 in 2023, slightly lower than 37 in 2022. This suggests that NIO was able to collect payments from customers more quickly. These numbers give us crucial information about NIO's financial health. They help us understand the company's ability to manage its assets, cover its liabilities, and maintain liquidity, key factors for any investor to consider. To get a comprehensive understanding, we need to look at the DuPont analysis. The DuPont formula breaks down return on equity, or ROE, into three components: net profit margin, asset turnover, and equity multiplier. This gives us a more detailed view of a company's financial health. In 2023, NIO's ROE was negative 71%, a significant drop from the negative 54% in 2022. This shows that the company's profitability, relative to the equity invested, has declined year over year. Let's break this down further. The net profit margin, which measures how much of each dollar of revenue is actually profit, was negative 38% in 2023 compared to negative 30% in 2022. This means that NIO was less profitable per dollar of revenue last year than it was the year before. Next, we look at asset turnover, which shows how efficiently a company uses its assets to generate revenue. In 2023, NIO's asset turnover was 0.47, a slight decrease from 0.51 in 2022. This indicates that the company was less efficient at using its assets to generate revenue. Finally, the equity multiplier, which measures financial leverage, was 3.93 in 2023, up from 3.49 in 2022. This suggests that NIO has increased its reliance on debt to finance its assets. So what does all this mean? Well, the declining ROE, net profit margin, and asset turnover, coupled with the increasing equity multiplier, indicate that NIO's financial situation is challenging. However, the key for the company is to improve its net profit margin. This could be achieved by increasing product pricing and sales volume, but it's easier said than done. While NIO's financial situation presents challenges, the key for the company is to improve its net profit margin. Remember, investing always comes with risks and rewards. Let's summarize what we've covered about NIO's financial situation. We've discussed the company's revenue growth, which has been impressive, but we've also highlighted the challenges in their profit margins. Despite their revenue growth, their net profit remains negative, which is a concern. We've also analyzed their assets and ratios, and while they have a healthy current ratio and quick ratio, their equity to total assets ratio has been decreasing. This could indicate a higher financial risk. We also touched on their inventory and receivable days, showing some efficiency in their operations. Lastly, we've discussed their DuPont analysis, which revealed a concerning negative return on equity. This suggests the company needs to improve its net profit margin to become profitable. Thank you for watching. Don't forget to subscribe for more analysis and drop a comment on which company you'd like us to analyze next.